Good evening. This is Ken Long from Tortoise Capital Management with the review of the daily health check for 27 June 2013. So we're looking at S&P. These are daily charts. This is about 4 months. The vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets that have been resistance or support in the past, which we use for framing for the long side. The horizontal red lines are support levels that have held in previous time frames that we look at as support levels or possible targets on the downside. Solid black line in the middle is the 30-period regression line lagging 1 day, and the outer black lines form the RAF regression channel, which is the channel formed by the maximum excursion from the regression line during the look-back period that occurred 2 days ago, and that sets up that channel. Solid blue shaded area is the river, the 30-period Bollinger Band plus or minus 1 standard deviation. The outer lighter shaded blue area is the floodplain, 30-period Bollinger Band plus or minus 2. So we're always interested when, like 2 days ago, we have price outside the floodplain and then starts to reverse. We think that's the beginning of a reversion to the mean, which in this case is this thin red line, which is a simple 30-period moving average, or the center point of the river, center point of the Bollinger Bands. The shaded orange area is a 2-period Bollinger Band, which we take to be the real price, and discount the tails. This thin black line is the time series of the slope of the 30-period regression line. You can see this dotted line is the zero line, and so the slope is negative, as we can see, because this black line is below, and it's starting to roll over here and find support. So the downward slope of the 30-period regression line is starting to bottom out here, caused by these last 3 up days in a row. It's slowing and maybe reversing the downward move of that regression line. That's a positive thing when that occurs outside of the river. This is the Williams percent R10. You can see we were oversold for a period of time in here, and now we're back to the midpoint of the 10-period trading range. This is the ADX. It dipped as low as 15 and now came as high as 22. It's now down to about 21.5, and the bears are still in charge, but the bulls have started to close the gap, and so this is a non-trending market with the bears slightly in charge but weakening based on the price action of these last 3 days. You can see that. So overall, we're still bullish because we're above the 200-period moving average, which is this red line with the shaded area indicating price below the 200. Price was more than 2 standard deviations away from the mean when it bottomed out here. It's now right back at the lower edge of the river, entering the river. That's a favorable location to buy momentum in a bull market with a target of either the Bollinger Band mean or the far side of the river. It won't be a return to the bull until we get a close above the swing high, above 167. I take it as the ribbon high and not the absolute high. So what I'm looking for is price over 167. So for me, this is tactical trading between 161 and 167, and also on the support levels to the downside. I really need to see price above 167 for this to resume the bullish leg that started all the way back here and came as high as 167. We're still bullish volatile. Looking at the percent price oscillator here, this is set up at 10, 20, and 8. And the jaws are still open to the downside, but they are closing, and the histogram is looking better, the same as you would expect from this kind of price. And so while the downward pressure is still the primary trend over the last 30 days, there is a sign of weakening. I would see a target of 164 in this leg would be absolutely normal. It gets you back to the mean, gets you back to the top of the regression channel, and still wouldn't violate this downward move. So this is the first tactical target of 164. and then above 167 for this really to reverse this this pullback. If it finds support here at 157 and continues on up, then this will just look like an extended 30-period sell-off. I think it's in response to the Fed hinting that they're going to start pulling back on the printing press, but we'll see. So still bullish market, but it's troublesome that the river has rolled over here and has gone started to go south as well. So the bulls got some work to do here to get us back up to 167. So tactical trading in both directions. If we get a failure at the Bollinger Band mean, coming back to 157 is the key support level right now. If that fails, I think it drops quickly to around 153, and if that fails, then we're heading back towards bearish market here at about 150. All right, so that's Ken Long for Tortoise Capital. Keep your powder dry and your risk measured.